Hello everyone, thanks for checking out my video. The US stock market continued to surge higher as dovish outlook from the Federal Reserve has sent stocks on their longest weekly winning streak since 2017. All three major indexes recorded a 7th straight winning week and hit their respective 52-week highs. In fact, Dow Jones Index actually hit a record high, while the broad market S&P 500 index is about 2% away from its all-time high, which was set in January 2022. So, are we going to hit the all-time high before 2023 ends? Did Christmas come early? Is this bull run unstoppable? I will be answering these three questions in this video, so do watch on to find out more. A very quick recap of what happened last week. So last Tuesday, the latest CPI report was released, and the numbers were kind of in line with expectations. The Consumer Price Index, a closely watched inflation gauge, basically rose 0.1% in November and was up 3.1% year on year. The estimates were no gain from previous month and a yearly gain of 3.1%. The core CPI, which excludes the volatile food and energy prices, increased 0.3% from last month and 4% from last year. Both numbers were in line with expectations. And then on Wednesday, the Federal Reserve paused their rate hike campaign for the third consecutive meetings. Not just that, Jerome Powell actually signaled that they are likely to cut the interest rates 3 times in 2024. Instead of the initial projection of 2 times. The central bank is now expecting inflation to fall to 2.4% next year, which is down from what was forecasted in September this year at 2.5%. On top of all this, Powell also acknowledged that they are likely at or near the peak rate for this cycle. Well, yes, he did caveat and reiterate the usual stuff of needing to see more evidence that inflation is indeed dropping to their 2% target. But I must say his speech was generally quite dovish in my opinion. In fact, I thought he was just short of declaring victory against inflation. And in case you can't recall, the last time round we had a rate hike was during July's FOMC meeting a good 5 months ago. All in all, the rare dovish message from the Federal Reserve had pushed the S&P 500 closer to its all-time high, while causing the bond yields to drop concurrently. The next FOMC meeting will be held in end January 2024. That's when the market will try to suss out clues and details again on when could be the first rate cut. But from now till then, the market is likely to continue to digest and move according to the dovish message that Powell gave last week. Even if we don't have a massive rally from the current already overheated market, I think at least there are some signs of relief for the market that inflation is dropping, Fed is turning dovish, and a huge dump or crash is quite unlikely from now till end January, unless of course some black swan events happen. But technical pullbacks are still possible. We'll share more on this later. Meanwhile, we will have a fresh inflation data this week, which is the Fed's preferred measure of inflation, aka the PCE price index. It is scheduled to be released on 22nd December Friday. This will be another data point to show whether the Fed's existing monetary tightening campaign is making enough progress to bring inflation down or not. Let's now cover the technical analysis portion. Ladies and gentlemen, in my last video I shared that SPY has a decent chance to break the 52-week high of 460.7 and charge towards the all-time high of 467. I also said there is even a chance to hit towards the top end of the green uptrend channel at 469 to 470. Look at where SPY is right now, 469. I hope that warrants a like button. Come this week, as I extend the green dotted uptrend channel line, you will see that there is still room for SPY to go up before hitting the top end of the channel, which is around 475. Before you get too excited and think that SPY will definitely hit 475, let's take a look at the prerequisite. Okay, the condition or prerequisite for SPY to hit that level is to hold 467. This is the first Fibonacci extension support level, and it is also where the middle channel line sits. It basically is a double support level. Therefore, if it gets tested and holds, then the chance of hitting 475 is pretty decent. But if it hits 475 or even goes slightly above 475 this week, I will be extra careful. Because when that happens, the RSI will be very overbought. And interestingly, when SPY hit the top end of this uptrend channel on the previous 3 occasions, it fell quite substantially. But just a disclaimer, I'm not saying it will happen this time and that you should short SPY when it hit the top end of the channel. Whichever trade you take, it's really entirely up to you. I am only dissecting the trend and presenting what I observe to you. Anyway, on the downside, if the earlier support level of 467 that I mentioned does not hold, I would say we may just fall towards 456. Because between 456 and 467, I don't really see much support. From this point, if 456 breaks, don't panic yet, because we still have the bottom end of the uptrend channel as support line, followed by the gap between 439 to 444 as support zone. Within the gap, we have the 50 moving average at 440, which acts as a support too. Okay, the last line of defense for this bullish momentum is around 437. By going below this level, it means SPY would have breached the 50 and 100 moving averages, broke below the uptrend channel, and also gone below the Fibonacci support level. When multiple support levels converge and get breached all at once, it's very bearish. So when that happens, it means center rally has been cancelled. Anyway, my honest opinion is that the odds of this happening from now till early January is quite low. Let's now hop over to Apple's chart. Well, for Apple, what other words can I use to describe Apple other than bullish? Ever since I shared about the bull flag on Apple's chart, Apple has been really bullish. In fact, in my previous video, I shared the following. In short, Apple is bullish now. I will not fight this bullish trend until I see bearish signs. The bull flag and the bullish cross on MACD give us a chance to test the all-time high of 197.7. Things are lining up for Apple to hit that all-time high. And all this have played out beautifully last week. So guys and girls, if you have found my analysis useful, do help me grow the channel by tapping on the like and subscribe buttons. I really hope my channel can reach out to more people. Alright, come this week, I think there is a decent chance for Apple to hit 200 if we can stay above 197. 200 itself is a resistance level, but once Apple claims that, I would say bulls are in good control because FOMO investors start coming in whenever a stock claims a psychological level. Above 200, we may continue to inch up towards 205, where the first Fibonacci extension level sits. Anyway, in my previous videos, I did share that when the stock breaks its all-time high, it usually can run up a bit more, which I think we are seeing that in Apple. But of course, nothing is 100%, so be prepared for a potential reverse trend. And here's what you need to look out for. First and foremost, as mentioned earlier, 197 is important. If Apple falls below that, I don't see much support all the way to 180s range. But this doesn't mean Apple will waterfall down to 180s. I mean, it may just chop around at low 190s range to create a base before flying higher. This could be a scenario of profit taking by institutions, which means big players are taking some profits off the table, but buyers keep stepping in, and overall we don't have a lot of selling pressure. Therefore, the stock holds its ground and moves sideways. Anyway, this is just a wild thesis from me, so take it with a pinch of salt. Okay, but let's say low 190 somehow gets breached, then the next immediate and significant support lies at 185, where the Fibonacci level is. Personally, the key area that I will keep an eye on for the downside is around 181 to 183, because that is where the 50 moving average, 100 moving average, and a Fibonacci level are. Only if Apple goes below this, then we can potentially say center rally has been cancelled. Okay, moving over to Tesla. Tesla seems to be a lagger. Previously, when the big tech stocks were rising, it was going sideways. But now when they were showing a bit of weakness, it rose about 4% last week and even broke out of the long-term downtrend line that stretches all the way to July this year. As we zoom into the chart, let me show you two bullish signs. First of all, we had that big fat green candle last Thursday that broke through the downtrend resistance line, and more importantly, it was supported by a decent volume. The volume was the highest since 19 October, where we had that massive gap down. The second bullish sign is that on Friday, Tesla's intraday movement saw the stock falls to touch the trend line and bounce back up later in the day to close green. This is what I call the classic textbook retrace and retest and then bounce up. Okay, for the bullish momentum to continue, we need one more candle above the trend line on Monday, and ideally a green one. If we have that, then I think there is a decent probability that Tesla may charge towards the recent high of around 269. At 269, to be honest, I think the resistance is quite weak. A stronger resistance is probably at the gap area, between 280 to 289. This is one potential area of rejection. Tesla may not fill the full gap and could get rejected already. But if it doesn't get rejected and closes above the gap, then I would say the 300 level is very much in sight. Hey viewers, since my last video, the revenue that I received from Super Thanks has increased from $299 to $749. A big thank you to these 3 latest viewers who have supported the channel via the Super Thanks. As shared in my last video, from what I understand, the minimum amount for me to cash out from YouTube is 150 Singapore dollars, which is around 113 US dollars. So there is still a long way to go. Some of you might have known I have started this channel for 2 years already, and I have not gotten anything from YouTube at all, so let's hope I can cash out something from YouTube soon. I know this 150 bucks is not gonna make me rich, but it's like a little milestone to keep me going as I continue to share this content for free. Therefore, do consider supporting the channel by purchasing a Super Thanks so that I can receive my first paycheck from YouTube soon. The button can be found below this video. Okay, back to Tesla. In terms of downside, it's quite straightforward. If Tesla retraces and retests the purple downtrend line and fails to bounce up, that means we could have a false breakout last week. When this happens, don't worry yet, because Tesla is just falling back to where it was consolidating for the last 1 month. As you can see, Tesla has been moving within this very tight range since 14 November, and there is a decent support level at around 231. Where Tesla seems to always bounce up whenever it touched the level. It is only when Tesla breaks below 231 that bears should get a little excited. The bears should only celebrate if they can take out both the 200 moving average at 226 and the next Fibonacci support level at 222. Anything above 200 moving average, there is nothing for bulls to be worried about. Lastly, I just wanted to highlight something. The Bollinger Band is getting tighter for Tesla, and if you recall, when B-Band gets squeezed, it is usually followed by a huge movement. I actually shared this on Mumu on 14 November before the market opened. And lo and behold, Tesla ended the day breaking out of the resistance line with a big fat solid green candle and followed by another candle above the line the very next day. So right now, we just have to watch if the breakout is a false breakout or not. If it's not a false breakout, the upside can be potentially massive. Lastly, let's have a look at Google's chart. Google is still moving in a very predictable range. At this point, I would say there is no clear winner between the bulls and the bears, which means there is no clear bullish or bearish direction, which also means it's good for option sellers. But options trading aside, we need Google to break out of this 127 to 139 area before we can ascertain a new direction. Anyway, for the last 5 trading days, it seems like Google was facing some form of resistance at around 133. Interestingly, 133 is formed by the 50 moving average and the all-important 61.8 Fibonacci level, thus creating a double resistance level. Therefore, if Google can break above such strong resistance level, I would say it has a very high probability to charge towards 138 to 140 area. So watch this level carefully if you are a Google bull or planning for a bullish trade. On the other hand, if Google gets rejected and falls, watch for the next Fibonacci level at 128. Actually, I will give and take a little bit and look out for 126 to 127 instead, because that is the bottom of the consolidation range, and also where the tiny gap sits. Basically, this 126 to 128 area should offer a decent support for Google to bounce up. I will only be on my toes if this area breaks. Alright, moving over to the options trading section. Last week on 12th December, I saw a cash secure put on Tesla with a strike price of 190 expiring 26th January. The rationale behind this trade was quite simple. First of all, as shared in my previous videos, I am of the view that Tesla will move between 200 to 240s range this December. And as shared earlier, Tesla has been moving sideways for the last 1 month, and this is good for option sellers because time decay works in our favor. The second reason was because Tesla has been bouncing off this 231 support line for the last 1 month as well, since 14 November. This shows that the level is one solid support level in my opinion. And even if this support level breaks, we will have the all-important 200 moving average at 226 to act as a strong support. Below that, we still have multiple decent support levels, namely the Fibonacci level of 211, psychological level of 200, and finally the recent low of 194. Therefore, in my view, my strike price of 190 does offer quite a lot of buffer for me. Okay, for this week, I have a Tesla covered call contract that is expiring on Friday 22nd December. The contract was sold on 17 November with a strike price of 290. Again, I was taking advantage of the sideways movements by Tesla and saw little catalysts that will push Tesla to the 290s range. Therefore, if Tesla does not fly towards 290 and close above 290 on Friday, my contract will expire worthless, and I get to keep the $150 premium without taking further action. Just to share, given the bullish breakout from Tesla, I am waiting for an opportunity to sell another covered call, which is a slight bearish move. Let's see if I can make this trade this week. Alright, I have quite a bit of thoughts to share this week, so do watch till the end of this segment if you are curious about my views. Okay, so right now, the market is celebrating the dovish tone from Jerome Powell. In fact, I think we just had an arguably the most important Fed decision and message of 2023, as Powell acknowledged that inflation has eased and signaled more rate cuts in 2024 than what was initially projected. Before the FOMC meeting, the market was probably expecting a hawkish pause or a more cautious speech from Powell, but instead the messaging was quite dovish and there was quite a big change in the language and tone used. Anyway, the next FOMC meeting will be held on 30th and 31st January 2024, that's about 1 month away. So does this mean that from now till then, the market may just keep going up? Well, let's bring back the questions that were posted at the start of this video and answer them. Are we going to hit the all-time high before 2023 ends? Did Christmas come early? Is this bull run unstoppable? The short answer to the first question is yes, we could potentially hit all-time high before 2023 ends. In fact, I have shared this in my last few videos. Anyway, I would give and take a little bit till the first 2 trading days of the new year to coincide with the center rally period. And did Christmas come early? I would say yes as well, as the market didn't expect such dovish message from Powell. I mean, as you can see, Dow Jones and Apple has already hit their all-time high last week, while both S&P 500 and Nasdaq are not far away. So yep, I do think Christmas had come slightly earlier. But there's always a caveat, which brings me to the next question. Is this bull run unstoppable? The short answer is no. If you had noticed, the effect of Powell's speech has worn off a little last Friday. Some may attribute this to the triple witching day, where the market usually has unusual activities and volatility. But in case you don't know, on the same day, New York Fed President John Williams said in an interview that talk of rate cuts is premature, which sort of contradicted with what Powell had shared the day earlier. This might start to cause or might have already caused the optimism of rate cuts to fade a little. And in my personal view, at times, I feel that the market could get ahead of themselves by too much about Fed's monetary policy. Therefore, I am of the view that there could be some minor technical pullbacks from now till January. Just minor ones, as I don't see any high probability of a major decline at this point. And just a disclaimer, if we do have some pullbacks this or next week, I will not come out to say that I have made the correct call for some pullbacks yada yada. As shared in my previous video, this is just a reminder to keep things in check and to remind myself, the bulls or general investors not to be too complacent amid the recent rally. At the end of the day, pullbacks and pauses are inevitable. What matters is how big they are and how long they last. Meanwhile, sharing some interesting information with viewers out there, as of 13 December, there is a total of $5.9 trillion parked in the money market funds. If interest rates starts to fall and we have a soft landing, we could potentially see some investors starting to adopt a risk-on approach and deploy their money market funds cash into the stock market. But as usual, before you get all too excited, I am always here to keep your emotions in check with some words of caution. First of all, not all the cash in the money market funds may be available as dry powder to be pumped into the stock market. Therefore, I would say some cash may flow into the stock market in months to come to keep the bullish momentum in place, but unlikely to cause a huge melt-up. Secondly, the VIX index has reached its lowest level since we had that COVID flash crash in March 2020. That's a good more than 3.5 years ago. This is not a red flag to me, but I would call it a yellow flag. The lower the VIX is, the higher the risk of a pullback. Okay, before you get all too confused on my stand as to why I always say something bullish and then caveat it with something bearish. So to put things in perspective, I am still 80 to 90% bullish on the current market, with about 10 to 20% of bearishness. I actually shared this before. It is just in me that I cannot be 100% bullish or bearish. My ultimate take is, it is good to be cautious when the market is overheated, but it doesn't mean that I sit around and wait for a crash or the big pullback to do something, because it may or may not come. What I am doing right now is I am riding the bullish trend until weakness starts showing. That's probably the most sound approach, at least in my opinion. And I will share with you viewers if I see that the market trend has reversed or is potentially reversing. Therefore, do subscribe to my channel for weekly updates and remember to tap the like buttons before you exit this video. Thank you.